Hi everyone, welcome to LIC IPO video. LIC is coming out with an issue size of approximately 21,000 crores, which is India's biggest IPO. At some point in time, LIC was expecting an issue size of more than 75,000 crores. Considering the current global market conditions, LIC has reduced its issue size and is coming out with an attractive valuation compared to its previous announcements. But is it really attractive? We shall check this out with some key data points. We shall start the video with brief history of LIC, some key data points and financials about the business, IPO details, valuations, potential risks and my personal view on this IPO. So let's get started. There is a large brand value associated with LIC. Most people in India assume life insurance as only LIC. Proving the above fact, LIC had a monopoly play in the life insurance business in India between 1956 to 2000. In the year 1956, many smaller insurance players were combined to form a single entity known as Life Insurance Corporation of India. During this period, there was no other company eligible to start a life insurance business or issue any kind of life insurance policies. Only in the year 2000, private players had the permission to enter into life insurance business. Coming to the present day scenario, LIC is still the largest insurance provider company in India. LIC has a total asset under management of rupees 39 lakh crore. LIC operates through 2048 branches, 113 divisional offices and 1554 satellite offices. LIC also operates globally in Fiji, Mauritius and UK. But their global operations is very small compared to business generated in India. Various subsidiaries and associates of LIC can be seen on the screen. Also, globally, LIC is the fifth largest insurance player in the world in terms of total premium collected. LIC presently has 1.33 million agents, which is roughly 55% of entire agents working in the insurance sector. LIC's agent network is most productive and is wider than the entire private life insurance players' agent network in India. The reason why LIC agent force is most productive is, on an average, a LIC agent sells around 15 policies, whereas in comparison with other insurance players, the number is just 2 to 3 policies. Even though there is a huge agent network for LIC, when we look into complaints regarding mis-selling of insurance policy, it is least for LIC. For every 10,000 policies sold, roughly 2.1 is the mis-selling complaint received, which is very low when compared to other insurance players. This helps us in realizing the brand value of LIC. Now let's get deeper and analyze some of the important data points. LIC has a market share of 64.1% in terms of total premium collected, 66.2% in terms of new business premium, and 62.5% in terms of renewal premium. If we check the total market share of private players, they have acquired roughly 36% in terms of total premium collected in last 20 years. For LIC or any insurance company, premiums are generated through two types of customers. Number one, individuals. Usually margins are higher for individual policies. Number two, group. Margins here are significantly lower when compared to individual policies. This is the chart for new business premium related to new policies issued for individuals. Private players are aggressively capturing the market share in this segment. Similarly, this chart is for new business premium related to policies issued for a group. Private players again are gradually increasing the market share in this segment. With this data, LIC still has highest market share because LIC's highest revenue contribution is from group insurance. When we look into the customer mix of LIC, we can see that group insurance generates 69.4% of its premium collected and individual policy contributes 30.6%. Customer mixes of other private players majorly focuses on individual policies, and due to this, private players' margins are very good compared to LIC. Before looking into the product mix of LIC, let's understand some key terms. There are two types of policies. Number one, linked policies. Linked insurance policies are often referred to as insurance cum investment plans. These policies are linked to the stock market and the returns are based on how the market performs. An example is ULIP plan. Number 2, non-linked policies. Non-linked insurance plans are traditional plans that are not linked to the stock market. It provides low risk returns and well-defined maturity amount and bonuses. An example is endowment policy, term insurance, etc. When it comes to non-linked policies, this is of two types. Number 1, participating. A participating life insurance policy, also referred to as par policy, allows the policyholders to participate in the profits of the life insurance company. In a participating plan, the benefits of these profits are passed on to the policyholders. These benefits are paid out to the policyholders in the form of bonuses or dividends. Typically, the payments are made every year on an annual basis. Example, endowment plan, money back plan, whole life plan, etc. Number 2, non-participating policies. A non-participating insurance plan, also referred to as non-par plan, doesn't offer any dividend payouts. In other words, the policyholder doesn't participate in the profits of the life insurance company. Example, term insurance. With this, let's check the product mix of LIC. 99.2% of LIC's total premium is through non-linked policies. If we look into other private players, they also have significant contributions through linked plans. Linked plans also have good margins. Coming back to LIC's product mix, out of 99.2% of revenues generated through non-linked policies, 62.8% of the revenues is through participating plans and 37.2% is through non-participating plans. For the insurance business, we look into the value of new business margins. Usually for participating plans, the margins are between 10 to 15%, whereas for non-participating plans or pure protection plans, margins can go up to 80% or higher than that. You can see that private players' product mix is more towards non-participating plans. Because of this, value of new business margin for private players is good when compared to LIC. From the table, we can see that the new business margin of various private players is mostly in double digit. When it comes to LIC, it is in single digit. But in the latest financial year, LIC has changed the product mix for their new business premium. In FY21, contribution through non-participating plan has been increased for its new policies. One should keep an eye on this parameter since a decrease in revenues through non-participating plans will decrease LIC's margins. Previously, we have discussed about LIC's agent force strength. From this table, we can see that individual agents contribute for 93.8% of new business premium. Another distribution channel used to sell insurance policies is bancassurance. Bancassurance is an arrangement between a bank and an insurance company, allowing the insurance company to sell its products to bank's client base. LIC has a tie-up with 70 banking partners and almost 51,633 branches of these banks can sell LIC insurance policies. LIC has one of the largest tie-ups with banks when compared to other players. But is this mode of distribution helping LIC? The answer is no. Nowadays, most banks are trying to promote their insurance policy like HDFC sells HDFC Life, SBI sells SBI Life, etc. Since LIC doesn't have any bank associated with it, this method of distribution is not much profitable for LIC. This can be seen from the table. The revenue contributed through bancassurance is just 3.1%, which is very low. When we look into the industrial trend on generating new businesses, banks and direct selling are increasing. If LIC doesn't adapt to penetrate through these kinds of latest industry trends, there are high chances that LIC can further lose its market share. Let's also understand how LIC has performed in generating the returns for its policy holders when compared with other players. Before looking into this data, I always say never mix investment with insurance. Before buying any insurance, always compare it with similar kind of products. If you're looking to buy an endowment plan, compare it with another endowment plan. This kind of valuation will help you in selecting the best product available in the market that suits you. LIC usually offers a saving plus protection plan, which is nothing but a non-linked participating policy. The yield generated can be seen in the table. Under all the categories such as life fund, pension, annuity fund, the yields are lower compared to other players. Looking at linked life products, meaning insurance policies linked with markets such as ULIPs, etc., they are underperforming significantly. The yield generated by LIC is just 10.6% in the linked life category, whereas most of the other players except SBI are generating returns greater than 30%. I'll be explaining the reason for this underperformance in the risks segment. Also, the risk taken by LIC in the policyholders fund is very high. The gross non-performing assets is less than 1% in most of the insurance companies. Coming to LIC, the gross non-performing asset is around 7.78%, which is very high. In investments, we say that if we take high risk, we can expect high returns. But in this case, even though LIC is taking high risk, the returns are below par when compared to other insurance players. Let's also check the growth rates of LIC in terms of premium collected. LIC has a single digit growth rate. These are some of the important data points one should check before investing in any insurance company. From the above data, we can see that private players have a better edge compared to LIC. If there is any significant improvement in premiums collected from non-participating plans, penetration through other distribution channels, higher yield creation for its policyholders, or any other parameters, then LIC would be generating higher margins. Coming to the financials, if we check on a standalone basis, ignoring other players, LIC is growing in terms of net worth and net asset value. But when compared with other insurance companies, we can clearly say that private players have better margins and growth rate. Let's have a look at IPO details. The issue size is 21,000 crore, which makes it the largest IPO in India. Government of India is selling a 3.5% stake through this issue. This is completely an offer for sale, and all the proceeds from this issue will go to Government of India. The face value of the share is 10 rupees and the price band they are quoting is between 902 to 949 rupees. We should apply a minimum of 15 shares, which makes the minimum bid amount as 14,235. As a retail individual, we can apply a maximum of 14 lots, which makes a maximum bid amount of 1,99,290. IPO opens on 4th May and closes on 9th May. LIC will be listed in both NSE and BSE stock exchanges on May 17th. The rest of the dates can be seen on the screen. Coming to the allocation proportion, QIBs is 50%, NIIs 15% and retail 35%. Discount is also provided for various categories. For retailers and employees, it is 45 rupees discount per share. For policyholders, a discount of 60 rupees is given. Let's look into the valuations of LIC. The most common parameter which is used to value any life insurance company is its embedded value. It is calculated by determining the future value of all the current active policies, meaning future profits of all the current active policies are calculated and present cash flow of LIC is also calculated. Adding up these two values will result in embedded value. Explaining in detail about embedded value will increase the length of this video. So in simple terms, embedded value is a kind of book value for the life insurance company. To understand if a company is trading at its fair value or undervalued or overvalued, we will be calculating a ratio which is market cap to embedded value. But again remember, based on only one single parameter, we shouldn't determine our investment decision. LIC at its IPO price values at 1.12 times, whereas HDFC Life trades at 4.1x, SBI Life trades at 3.1x and ICICI Prudential Life trades at 2.5x. Even though LIC IPO is priced very attractive, I'm still not very much comfortable with its pricing. We will check out the reason in the immediate next section of the video. Risks. The number one risk I can see is its embedded value. Look at the embedded value as on March 31st, 2021. It was 95,605 crore. But if we see the embedded value as on 30th September 2021, there is a drastic increase in figures which is 5,39,686 crore. This drastic increase in embedded value is not due to company's stellar performance during these 6 months. In fact, total premium collected were way lesser than the previous financial years. When we analyze the reason behind this, there was an accounting policy change that occurred during this period. Stated that in the future the bonus given to participating policyholders will be reduced and profits given to the shareholders will be increased. So basically the major beneficiary of this change will be Government of India, as they would be holding significant shares. For people who don't know what bonus is, it is nothing but sharing some part of insurance company's profit with its policyholders. Going forward, the bonus given will be reduced, which might have an impact on attracting new policyholders. Due to this accounting policy change, there has been an increase in LIC's embedded value. These risks are mentioned in RHP under the risk section. You can read through below mentioned points to understand more. Number 2. We all know that LIC is one of the biggest institutional players heavily invested in Indian stock markets. This point can be looked from a positive and negative viewpoint. Positive because during distressed situations such as market crashes, it is LIC that pumps in more money to keep the market stabilized. This scenario helps LIC to acquire quality stocks at attractive valuation and make profits out of them. Negative because many times we have seen that if any big PSU IPO issues coming out, then if the issue is undersubscribed, LIC is forced to subscribe to such issues. Also, in some cases of bankruptcy issues like IDBI Bank, etc., our government forces LIC to increase its stake in such companies. Due to this, LIC ends up investing a huge chunk of money into bad assets, which can be seen from the figures of gross non-performing assets. This is one of the reasons why LIC is not able to generate better yields when compared to other private players. Number 3. Another important risk is related to any policy changes in future. One of the recent examples to understand this risk was IRCTC. There was a sudden announcement made on October 2021 from the Ministry of Railway mandating to share half of its revenues from conveyance fee charged on internet ticketing with the ministry. Any news of this sort will have significant impact on the stock prices. Number 4. Currently, Government of India is selling only 3.5% of its shares. As per SEBI guidelines, the promoter of a company can have maximum shareholding of 75%. A period of 3 years is given after the issue for the promoters to reduce their shareholdings. So in the near future, government may come up with an offer for sale and sell additional shares in the market. Usually at the time of OFS, since there would be more supply of shares, the prices tend to fall. So as an investor, we need to keep this risk also in mind and act accordingly. Number 5. Performance history of PSU stocks and large sized IPO. Other than a few monopoly stocks such as IRCTC, most of the PSU stocks have been a wealth destroyer. In the past, whenever a huge IPO issue comes up, most of them have destroyed the wealth rather than creating wealth. Before sharing my view on this IPO, there is a standard disclaimer. Whatever information provided in this video is purely for educational purpose. Along with this information, kindly do your due diligence before investing. Invest only if you understand the pros and cons of the company. In case you don't have enough time to do research on this company, kindly contact your financial advisor. My long-term view is I won't be applying for long-term, since there are better companies generating better margins in the same sector. I would prefer to hold HDFC Life and SBI Life. Disclaimer, I am holding these stocks in my portfolio and this is not a buying or selling recommendation. Coming to my short-term view, there won't be any significant listing gains since the issue size is very large. Based on the last day subscription status of QIBs, NIIs and anchor investors data, I may apply few lots under the policyholder category only. We'll keep you updated on the last day of subscription if I am applying or not for the short term. If you think the information was useful, support us by pressing the like button and share this video with your friends and family members who are interested in applying for this IPO. If you are a first time visitor to our channel, don't forget to subscribe. Thank you and have a great weekend. Bye.